All right, good morning, folks. There you get to hear a little bit of my botched guitar playing as we enter the new trading day. And especially exciting about today is the VIX, which is actually performing a lot better than my guitar playing. So that's exciting for us. As we see the VIX take out the 27 level and now below 27 down to 26 and change. Now, for those of you who may be new here, my name is David, and I am a trader who focuses on the VIX. Now, the VIX is the so-called fear gauge. Well, what does that mean? Well, the VIX basically is a measure of option prices in the S&P 500, which is the main trading vehicle in the world. The S&P 500 currently has been coming back from a big down move when the whole virus thing started. And so the people have a lot of questions about the stock market right now. First of all, why is the stock market still doing okay when it seems like there's like chaos around us? A. B, what should we do to move forward to make money? That's people's biggest question is, how can we make money in the stock market? And the VIX has been a way that I have found to successfully make money. And one of the great things about the VIX is that the products associated with the VIX are very inefficient. Now, that might sound bad. You know, when you hear inefficient, you're like, well, why would inefficiency be good? Well, it's good in the case of this because what we do is we take advantage of these inefficiencies to make money by shorting these products. So if we pull up a chart of Vix Futures, I'll go to Vix Central here, we can see that the futures have rearranged themselves in a shape of contango, which is the normal shape, but we were out of this normal shape for several months. Actually, for over 50 days, we were in a shape of backwardation. So now you can see the front two futures in the VIX here illustrated 27.20 and 28.50. And if we look down to the bottom of this chart, we see this number, 4.78%. Now, what this means is that these futures are in relationship to each other, are in such a state that as we move forward, the way that VXX or UVXY or TVIX are set up, they are a combination of two different futures most of the month except for one day when they're just one future. And as the days go out in time, what happens is the closer to expiration futures are replaced with farther out ones. So if we pull up if we can go to the website for UVXY as an example, which is administered by ProShares, we can look at the composition of UVXY. And I'm going to this daily holdings. And so it shows here June futures, 11,500. May futures, 3,600, and then it has these swaps. Now, swaps are a cheaper way to replicate this futures relationship that save the company a little bit of money, but essentially are doing the same thing and in the same ratio of these as these futures, the swaps have the same effect as a ratio of futures, I should say. And we can see here, well, it's mostly made up now of June futures, the May ones less and less. And if we were to move forward to tomorrow, it would be even less. So they are switching, they're getting rid of these May futures and instead buying June futures. And so if we go back to our chart here, we can see the VIX on the bottom here and then these futures on top. Now, one of the aspects of this relationship here is that the futures are always going to be heading towards the VIX because futures have to be the same price as the VIX on expiration. So when the VIX is lower than the futures, which is like 80% of the time, futures are getting pulled always down towards the VIX. So if I take out my little pen here and paper, okay. So if these futures are being pulled down towards the VIX, and I'm going to illustrate this with a little down arrow here. As you can see this front month futures, they don't have as far to go to get down to the price of the VIX as the second month futures. So as we slowly replace the May with June futures, it gives them more room to fall down towards the VIX price. And this is really what creates the decay or inefficiency in this product. Now, if we had a totally efficient product, it would just always be the same price as the VIX, this 26.79. If we could actually directly trade the VIX, you could just buy 26.79 or sell 26.79, and thus, when the VIX got low, you could buy it, and when the VIX got high, you could sell it and make money that way. However, this isn't the way this works. We can't trade the VIX. All we can trade are these products that are based on these futures, and these futures, as I'm explaining here, are always getting pulled towards the VIX, and this creates decay. So a simple way of thinking about it would just be that this number, 4.76%, shows how much these products are going to decay per month as long as we stay in this state. Now, this is today, it's 4.76%. Tomorrow, it could be 5% or it could be 0%. But on average, it's going to decay over a month, whatever the average percent is per that month. So if we look at, if I go to this contango tab here, we're going to switch. Let me get rid of my pen here and go back to the real screen. If I go to this contango tab here, we can see how the kind of the trend in what that percentage number is. So here, if we isolate just the last period of time here, we can see, all right, so we've been, anytime we're above this red line, we're in contango, and we can see we've just kind of emerged recently back into contango. If I just isolate this down to just since February, you can see this whole period of time we were in backwardation. Now we're back up in contango here, 4.3%. I can back up through the days, and if I look back to May 8th, it's 4.7%. If we go back to the middle of last month, it was negative 14%. So as long as we're in the positive here, stuff is decaying to the downside. And one way of kind of helping you understand that is if we were to look at a chart of the VIX, I'm going to pull it up behind me. You get to see my smiling face for 2 seconds, and then we switch back to the VIX here. So if I pull up a chart of the VIX, if we're decaying over time, what that's going to mean is that like maybe a VIX of 40, 1 month a VIX of 40 might represent a TVIX of 200, or let's say, a VIX of 40 might represent a VIX of 40 might have TVIX trading around 200. However, as we decay, VIX of 40 might have TVIX only worth 100 or 50 or 25. And in fact, as time goes by, stuff decays. So let's see if we can kind of illustrate this. So I'm going to pull up a chart of the VIX, and then I'm going to add a chart of TVIX. So if I go to studies, add study, and it's kind of hard to do with 2 screens here, but let's see if we can accomplish this real quick. So study, add study, compare with TVIX, compare with new symbol. All right, TVIX. And all right, so here we have over time, you can see it's kind of illustrated like right here. You can see VIX here is staying, in the 10 to 15 level, and TVIX is slowly becoming lower and lower in price. If we back this out a little further, let's see, 180 days. Let's even go farther out here. Let's go to 1 year maybe. If you look at this part of the chart here, you can see the VIX is staying the same, but which is this colored lines, and then the purple line is TVIX. So the VIX is staying the same, but TVIX is going lower and lower versus that price in the VIX all the time. So what this means is that TVIX is decaying, and so even if the VIX stays the same price, we can still make money to the downside. So what this means in real terms is that even if the market just stays still and doesn't really move up, we can still make money being short VIX products. So they say VIX products replace being long the stock market, but in a way, they can be better than being long the stock market, because the stock market you only make long if the S&P goes up, whereas the VIX, you can make money when stuff is kind of going sideways. I was watching this Lance Roberts show this morning, and he was saying, well, the market is definitely going to, or I don't know if he said definitely, but he was basically saying what's going to happen is that we've reached kind of a point where the market's going to move sideways, and then in June it's going to go lower. And it always is amusing to me when people tell you what's going to happen in the future, because we don't know what's going to happen in the future. People have different levels of thinking they know what's going to happen in the future. The reality is here we are right now. You can see the market. This is a chart of the E-minis, which represents the broad market. You can see we were up here, we went way down. Now we've come back a lot of the way. We don't know what's going to happen from here. However, what we do know is that our charts of the VIX are back in that decay area, and thus it's an advantageous time to be short the VIX right now. The real question is, yes, these products are decaying slowly, but will they decay enough and significantly enough to counteract the next spike? So we don't know the answer to that. All of trading is a little bit ambiguous, but that's kind of where we sit right now. I wanted to show you once again the positions that I have, because I'm trading a very illiquid position in SVXY, and so it does some very funky things. And currently, I like to show my profit and loss statement, and if you look to the top of the screen, I may need to kind of readjust the screen just slightly here, but let me do that. Okay, so there we go. If you look at the P&L next to me on the screen here, you can see it says liquidity $314. So that's kind of less than we were yesterday. And the reason for that is because of marks. Now, what marks are is your position, or your position, or all the stuff that you own or are short, your position being whatever the sum total of what trades you have currently on, is valued based on the prices of the products that you're trading. And in this case, because I'm trading something that's so illiquid, the prices got valued in a very strange way. So let me show you that real quickly, because I think this is interesting to learn about, especially before you're going to jump in and trade, because it shows my account being down a lot of money right now overnight, but I'm not worried about it at all. And this is because I know where it's coming from. So if I pull up the options that I own in SVXY, and this is where this is coming from, and if I highlight it here for you, we can see, if we go to marks here, we can see I have this trade on. It's a butterfly, so I own, it's a butterfly, you own one of the wings versus two of the center. So so you can see here, I own, it's skewed by one option, but I own 41 of the 50 calls, and I'm short 81 of the 70 calls, and I own 41 of the 90 calls. Now, a call with a lower strike price should have a higher value than a call with a higher strike price, and this indeed is the case. However, the mark, or where it valued the 70 calls that I'm short 80 of, it valued them at $2.48 last night. Now, these calls right before the close, the market was something in the range of 60-cent bid at 70 cents. So these are valued, you could say, 3 to 4 times higher than their actual value. And that just has to do with the fact that the markets were widened out after the close yesterday, and as soon as we reopen, this value will this value will come back into line, and it's showing here me losing, I think, $15,000 yesterday on this option because it got valued at $2.48 when its actual value is really around 65 cents right now. So pay attention to where stuff is getting valued and understand your position, and then you don't need to be worried when you get bad marks like this. And you know, the simple answer to this for new traders is don't trade stuff that's very illiquid, like this sort of thing that I'm trading. You know, I'm an experienced trader, so I feel comfortable with trading illiquid things. In fact, I specialized as a market maker options trader in illiquid stocks, and so I feel comfortable with this. But I would suggest to you, if you're starting out, to trade something that's more liquid. Now, the most liquid VIX product really right now, I would say to trade, at least options wise, would be VXX, and it's probably the best one to trade stock wise as well. And one of the reasons I say this is that VXX is not a leverage product. When you have a leverage product, you're asking for you're putting more risk on. In fact, VXX really blew up recently and went higher than anybody was kind of even warning about. If we look at VXX here, TVIX here, went up higher than anyone was really warning about. And this has to do with the fact that it's 2 times leveraged, and several days in a row moving in one direction caused the price to skyrocket from a low of 38 and change here all the way up to 1,000 and then back down. Now it's currently 143. And you know, 1,000 is several multiples of 38 and change, way more than, you know, 100 or 200%. So this really illustrates the fact that leverage products can be extremely dangerous. VXX, if comparatively in the same time period, went from 13 to 78, which is still, you know, several multiples over 100% move, but not as extreme in this case. In addition, the reason why I say VXX is a good product to start with when you're trading the VIX is that the options are more liquid, and this means that you can buy and sell stuff more easily, and the markets are tighter. One of the ways we can tell if something is liquid is just looking at how many options are trading per day and the open interest. Open interest being how many contracts are out there. When an option starts trading, it's different than some other products in that when you sell you can sell an option contract without actually owning anything to start with. It's just a contract. You're making a deal saying, I will. If you're selling a call, you're saying, I will. And if it's something that settles to shares, you're saying, if I sell a call at a certain strike price, I will honor the obligation of giving someone the right but not obligation to exercise this option in exchange for 100 shares at a certain price. So when options start out in a new series, there's no open interest, but if we look on the screen, we can see further out in time, we can see as people start to trade stuff, how many of these contracts have been written out there, how many of them have been sold, and that's going to give you an idea of how liquid stuff is. If more stuff has been sold, if there's been higher volume, it's going to be easier to trade because there's going to be more people interested in that particular option. So if we look at VXX here and we go, the most liquid options are usually the front month, and if we look at, or front week, and if we look at VXX here, we can see, okay, at the money front week, we've got 12,000 of this one, 21,000 of this one. Conversely, well, TVIX doesn't even have options, but if we go to the similar in UVXY, let's take a look. And generally, I don't trade front week options, so this isn't as important to me. If we look at UVXY, much smaller numbers here, 300, 100 versus, you know, multiple tens of thousands in VXX. And if we go out to like the 6 months out period, or the 3 to 6 month out period, stuff that I'm more interested in trading, let's go to these September options. Okay, we can see here UVXY, you know, a couple of the strikes have like 5,000, but most strikes have like less than 100 traded. So very illiquid out here farther out in time. If we compare that to VXX, and we go out to September, also relatively low compared with another stock or different stocks or equities out there, but still more options than VXX. Let's compare a popular stock like Apple to this. So if we look at open interest in September in Apple, well, it's not super high. Still, you know, in the thousands. It's higher than both of those, but not super high. Here's Apple front week, 12,000, 14,000. Let's take a look at SPX open interest and see what we've got there. Now, SPX has so many different expiration time periods that it's hard to pick which one should be right. Look, we've got expiration today, tomorrow, the next day, a couple of days from now. There's so many different expirations that the order flow gets spread out between these different expirations. So, and although you don't see a super amount of open interest, look, we can see here open interest of a little bit higher, 56,000 there, 31,000 there. And although 100,000 on that strike, although we don't see a huge amount of open interest, there are players out there who are willing to make a tight market in this SPX stuff. Here we can see 62,000, 31,000, much higher than our UVXY or VXX here as we check out that particular open interest. I'm just going to the to our screen here for a second and check out what's going on. So once again, we come into the day with a slight rally underway. This has kind of been the scene lately, is just slow rally. Market's not moving a lot. Every day, volatility seems to be going lower. If we look at the VIX here, I'm going to pull up my open interest. I don't want to listen to myself. There we go. If we look at the VIX here and we go to a weekly chart, you're going to see just, let's say if we go to like a 20-day chart, okay, it's almost every day that this has been down in a row, just down, 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 every day in a row. Now, will this continue forever? No, of course not. The VIX oscillates up and down, but we are in certainly a downtrend. Now, of course, we saw this pop here. Look at this pop, a couple days pops up, but the overall trend has been lower. We've come from 47 down to 26, so it's down by, you know, roughly 50% in 3 weeks. So really a big move down in the VIX here. The average of the VIX is usually in the low 20s, so we're still above average, which makes sense. We're in a pandemic still. But VIX has really come in a lot. It's been a great short to have on lately. The positions I've been trading have worked out. Even though the screen says my account's worth $300 right now, it's actually worth quite a bit more, and the value has gone up over the last few weeks, which is a good thing, of course. I was watching on TV. I just want to say something for people out there. Please be careful, folks. You know, maintain your social distancing and whatnot. I was watching the Lance Roberts show this morning, and he was talking about how, you know, he's kind of laughing like, oh, those crazy Americans, they don't want to wear masks, and so they're going out in public right next to each other as if it was like really funny or something. You know, take care of, protect yourself, protect your children, protect those around you by wearing a mask, and don't get caught up in this stuff like, oh, you don't need to protect yourself and it's not a worry for you. Be careful. It's, you know, err on the side of caution here and protect yourself when you're out in public. Don't get too close to people. We want to be part of the solution here in this pandemic situation. And, you know, the case people are making is essentially that they're sick of social distancing and they want this to go away, but science doesn't work that way, that you can just will a virus to go away. We don't know that much about this right now, so please be careful out there. Don't be part of the problem. These restaurants that are opening in violation of the government, and, you know, there's in my mind, it's very serious. There's blood on someone's hands if they're going to open up and ignore social distancing and have people coming in close contact to each other and encourage this sort of situation. People can't seem to look at the consequences out in time. They just look at today. And, all these people, like that restaurant in Colorado, the people go to the restaurant, they're like, oh, they come back from there, they're like, oh, that worked, I'm not sick right now. But we've seen over and over again these situations where, like, weeks after that, all these people that were in that situation are all of a sudden sick. So don't let that be you. The other thing that's very worrisome is I think we all had in our minds at one point at the beginning of this whole thing, oh, well, wouldn't it be, it might be a good idea just to get this, then we're immune from now on and we'll be able to go back to work and not worry about anything. But from talking to a friend who's working as a nurse, there are some lasting side effects to this for many people that it's not just over when you recover from it in certain cases. So it's not a good idea to just expose yourself to a deadly virus. So this isn't like taking a flu shot at this point. We don't know enough about it yet to be taking those measures. So that's my rant and rave for the time being. So really amazing moves in the VIX lately, and this has been working. The lower the VIX goes, of course, there's this kind of FOMO thing where it's like, do you really want to sell the VIX at the low? When we look at the VIX, or anytime we've made a big move in one direction, for me as an experienced trader, I'm cautious about starting a position when we've made a big move in one direction, because if we kind of just bounce back a little bit, if the VIX goes back to like a 35 or something, and I started a position when it was down at 26, then I'm getting kind of whipsawed. So it's kind of the same advice I give a lot of times to people. If you haven't initiated some sort of short, you might want to, the best times to initiate a short is during when we have a pop, and pops in the VIX happen all the time. So when we look at the chart right now in front of me, if you haven't initiated a position, it doesn't seem like it could still work, certainly, because this is expected to slowly move lower, but it would certainly be nicer to initiate a position when we get a little pop like we got last week here than down here. And that's kind of like always the case. Conversely to that, it doesn't necessarily, people try to like group all of their market knowledge in one bucket, and you see this all the time when somebody will list a series of different charts and analyze them in a row. And it always strikes me as kind of amusing when people do this with the VIX products, because VIX products operate differently than regular stocks, and just applying the same sort of analysis to VIX products as you do to stocks does not make sense, especially when it comes to kind of picking a bottom. When you have a stock makes a big down move, you might say, oh, well, this is a bargain here, I'm gonna start to maybe scale into a position. Well, the truth of the matter is, with these VIX products, especially when we're in contango, is that they are a one-way train down. Now you'll have little spikes in between, but essentially they're slowly moving lower. And so any given point in, say, TVIX, for example, TVIX right now 134, there is a possibility that we will never see 134 again once it hits 133. And that's not really as true with stocks. Stocks generally trend higher over time. So don't get in that mindset of traders that are trading stocks that the VIX is and these VIX products are like stocks, and that a down move is a bargain that should be bought. We see that all the time in the different in the volatility trading group in Facebook. We see it all the time. A down move is thought as a discount in TVIX, for example, and people are buying it. We had somebody come on and say, perfect example last week, say, oh, 178, great buy in TVIX. Who's jumping on 178? Well, now it's 134. So when we do get, what we say in private in our VIX groups is when we do get like a spike in volatility, you get all these new people coming in. And when we have a spike in volatility, if you happen to be long TVIX or UVXY at the moment of the spike, you can make a lot of money all of a sudden. But it's very, very difficult to time. However, for some reason, we have a spike. All these new traders come into the market and buy TVIX and UVXY and get very excited. And inevitably, people will continue to do that, and those who make money on the initial spike, they tend to give it away subsequently as these things move lower. So don't fall into that category. If you're going to buy a TVIX or UVXY, if it doesn't work after 48 hours, get out of it. This stuff is trending lower. And yeah, you can get lucky and buy one of these ahead of a spike, but it's just that, getting lucky. And for us to make consistent money in the stock market, we don't want it to be a situation where we get lucky to make money. We want to be in a situation where we make money most of the time, and if the odds really go against us, then we lose a little bit. That's a better side to be on, in my opinion. All right, so there we are. Thank you for all the support that I've gotten recently. I know people are not as focused on the market as of late, but there's money to be made out there, and this is a beautiful time period for those of us who have been short this VIX stuff, and we'll see how it continues. As I said in recent videos, the market, it seems inconceivable to me that the market can just go straight up forever, especially with all the bad news we've had lately. So I would keep stuff small. A VIX position should just be a component of other stuff that you have on. It should not be like the main focus of your finances. Certainly, it should be a smaller part of your portfolio, but we do focus on it here. But just to note for people, I have savings that's in other stuff that's much more conservative, and you should too. All right, hope that helps as we're coming into the market today. Best of luck to everybody. Thank you to all the Patreon supporters and members of the channel. Feel free to pick up a membership. It's like $1.99. You get a nice, it's got an avatar next to your name, and it just shows support for the channel. Helps me continue to give you good content and interviews and whatnot. We're going to be expanding to get out of the studio and back outside for some broadcasts coming up soon, so I'm excited for that. Thanks for watching today. Best of luck trading, and we'll see you next time. Let's see if I can put some bad guitar playing on again for the outro.